most of you already know by now that the ETF structure allows you to access a variety of fixed income assets. These include government bonds such as treasuries from the US and Canada, and also investment-grade corporate bonds which are issued by public companies. But increasingly, we've also seen an expansion into alternative fixed income, assets that were previously hard to quote access, but now made much more accessible through the ETFs. And one of them are the so-called CLO ETFs, which stands for Collateralized Loan Obligations. Now you might be thinking, hey, these sound really close to the CDOs, the collateralized debt obligations that almost brought down the global economy in 2008. And on the surface, yeah, the terminology sounds similar, and some of the mechanics even too. But the difference is that the underlying is a completely different beast. And here's how to think about it. When you think about a loan made from an investment bank to a company in order for them to fulfill their capital expenditures, these are what we call leveraged loans. They're not like the typical bonds you see. It's more of a direct relationship, almost similar to private credit. Now, the cool thing is that if you get enough of these private loans from said banks to companies, you can actually pool them together and securitize them, meaning that it's able to be traded between parties just as you would a bond. Now, pool enough of these and you can form a tranche, which is kind of like a tier for how risky these are. And you have tranches that go from, say, double B to single B to triple B to single A to double A to triple A, and that's correspondingly how much risk they have. The lowest tranches of the CLO are the riskiest, and in the event of a loss in the underlying loans, the investors in these tranches take on the first brunt of losses, but they also earn a higher yield. Conversely, at the top, at the AAA level, they take losses last, if any. It will take a significant amount of stress in the underlying loans for the AAA tranche to be affected, but they also earn a decent yield. And a lot of these CLOs have yields that are pegged to a benchmark such as the Secured Overnight Finance Rate, or SOFR. So it's usually SOFR plus 2. So what you're getting is floating rate loan exposure that is defensively positioned because you're high in the capital structure as the AAA. And these are secured often by first lien leveraged loans made directly between banks and the companies that have priority over, say, preferred shares and common shares. The problem with CLOs in the past was that accessing these is hard. They're very much a securitized fixed income product, and that means they trade over the counter, and as such, it's hard for retail investors to get access. But through these partnerships we've seen with ETF issuers, we've been able to package them into a liquid exchange-traded structure. And the way to think about this is that as an alternative source of yield that has characteristics unlike traditional fixed income. CLOs are very resistant to rising rates because a lot of these are pegged to a benchmark using a floating rate structure. Compared to traditional high-yield bonds, they have much higher default protection because they are higher in that capital stack. And when you buy the AAA tranche, you get more protection, although less yield than, say, the double B tranche. Now, the million-dollar question is, are these different from the collateralized debt obligations? We talked about some of the similar mechanics, tranches, AAA, triple B, losses from one to the other, but the difference is in the underlying. Fundamentally, the loans backing CLOs are different from the subprime mortgages that were backing CDOs. These were not properly stress tested during the Great Financial Crisis, often relying on incomplete housing market data and incomplete correlations. And thus, when that systemic risk happened, a lot of these CDOs collapsed. CLOs have been around just as long, 30 years, and they survived not only the Great Financial Crisis, but also the 2020 March COVID meltdown with great resilience. And part of that is because of how diversified these are and the strength and the senior status of the loans backing them. Now, when you package CLOs into an ETF, you get that liquidity, but you also get the convenience of monthly distributions. There's no need for you to manage these leveraged loans that you would otherwise not be able to access on your own, but the ETF manager does it for you, pays you monthly, and you can trade it with the convenience of a single stock. And I think that's why this new category is so exciting, because for once, Canadian retail investors have access to something that was really only available to the big players, and you could do it at a low cost and with great transparency.